Okay, folks, welcome. I think we'll get started. I appreciate your time. We're here for the top 10 tips for Australians to retire successfully in the UK. Some of you may be British who are returning from Australia, which will be very similar, but not quite the same. This evening, I'm Stephen Ford. I'm the head of UK financial planning. I'll be doing a fair proportion of the presentation. Working with me will be Kevin Tutt, who's a financial advisor. He also specialises in Australia and UK advice. And we have Simon Harvey, who is the owner and general manager, who's dual licensed in both countries as well. He'll be sitting there taking note of your questions, and we'll be answering those once we get to the Q&A section. You'll see a little button at the top, Q&A. If you can use that predominantly to answer or ask your questions rather, then Simon will sit there and take note of them and get ready to answer them when we get to the question section. There is a chat function if you want to ask anything, or if you're stuck or you need help in some other way, but try to keep the questions in the Q&A if you don't mind. It just keeps it a bit simpler. We've got a lot of information here. I guess probably more than top 10 tips really. A lot of it we will go through at a high level. It's as much to sensitize you as anything else, not necessarily to go into an enormous amount of detail, but just help you understand some of the issues involved. We will send you this guide and the video, or a copy of the video, at the end of the session, probably tomorrow, maybe Monday. So you don't need to remember it all. Maybe don't necessarily need to take notes even. So you will get that. And of course, you're welcome to arrange a meeting. We'll leave some information on a screen later where if you want to chat personally about your circumstances, you're welcome to ask. We'd prefer you keep it on mute. We know sometimes you like to double task, and so you're perhaps listening in the background, but doing other tasks. But if you could do that just in case there's any interruptions and so on, that would be great. If you have any questions before we begin, then perhaps if you just want to raise them if there's any issues. Otherwise, we'll just carry on. If anything's going wrong for you in the chat function, just make a note there, and we'll see if we can get someone to rectify it without really interrupting the flow. I guess we are talking about retirement. We're not presuming that you're all near retirement or in retirement. We are presuming possibly maybe in your 40s and you're looking to build a solid foundation for your retirement. I guess one of the critical questions is, what actually do you want to do when you get to that period of your life? I guess the old sort of story of you work, then you quit completely and just become retired is probably no longer valid. We're working longer these days. So our aim here is to make sure that we understand or help with that process, and that you have enough to fulfill those ambitions through your rest of your life. So we've got a series of points that just give you information, and then I guess an action list which helps focus on some of the things that you can do now, or some of the things you may get to give attention. And of course, as we go through that, you'll get an understanding of how we can potentially help you in developing your retirement plan. I guess one of the key questions often people want to know is whether they're going to have enough, inverted commas, for the rest of their retirement. I guess we spend maybe age 18 through to 55 or 60 working, which is about 40 years or so. But we could equally spend just as much time in retirement, but we're not working. So now we need the funds and the income to basically support our time through life. I think a 65-year-old now, on average, lives to 85. There's a 25% chance that a 65-year-old will reach the mid-90s, and a 1 in 10 chance they'll reach 100. So you've got to contemplate that you may live for quite a long time, and we'll need money to support that. You can see here, we've got a cash flow diagram we're talking about. You can see red in this particular model means you've run out of money. So this is an example of someone that actually came to us, and when we looked at what they were spending, which was perhaps too much, and looked at their income and resources, it was like, well, okay, you're really going to run out in under a decade. And so it helps frame the question of, do you have enough? And a lot of the process is helping model that and invest wisely and take your income wisely to make sure you do have enough to fulfill what you'd like to do in retirement. I guess to help that process, and not everyone needs to be clear, not always is it very easy to be clear, but it often involves some basic questions about what do you actually want to do in retirement. Do you want to phase it? You're going to travel a lot. You can take up new hobbies. You know, how's it going to work? And of course, then that means that you need the resources financially to be able to support that. We often find people are probably somewhat pessimistic about their retirement. I won't have enough. They don't really dream much about what it could be like, particularly if they're younger, and therefore don't really perhaps appraise the ambition and make that forthright. So we encourage that sort of activity as well. It may not always be possible, but without knowing that, it's difficult to design that. And retirement is becoming more flexible these days, part-time work, working longer. The pension freedoms that come in now mean that you can take your British pensions a lot more flexibly than they used to be. I'm just setting the broader context here. We'll get into some of the detail in a moment, but one of the main areas that we work in financial modeling is what we call lifestyle modeling. And that's basically looking out across your life and understanding your expenses, how they might change, and then looking at your sources of income and how that is going to need to be built up both while you're employed and generating income, but also fundamentally when you are taking your retirement income and you're taking it out of your assets. And this is an example again of a client where, again, they were running out of money towards the end of the life, so it perhaps wasn't a safe plan if they lived beyond those ages, mid to early 80s. You can see afterwards, once we'd worked with them to understand what they were trying to achieve and to address their investments and to address the tax efficiency of that, then you can see that all the red went away. And so right through to 100, which makes it safe, or 95, this client was in a much better position to have the lifestyle that they wanted, and without the concern over not having enough resources. Same person, you can see we also model tax. So the top diagram is just their tax per year. So it's £3,000 or £4,000. You can see it rises towards the end, but that's largely because all the assets that attract the most tax have been delayed. So a big part, and we'll reiterate this through the presentation, a big part of what we do is just work out how to phase that so that you use the ones that aren't taxed earlier in the process, which leaves more invested, which means the returns are greater, etc. The bottom chart there is the net wealth. So again, you can see over time that the wealth generally increased to quite a substantial amount. This is all done in inflation adjusted, so it says 4 million or so towards the end of the graph. That's in today's money, so that's showing how that wealth grew. And you can see the different colors. The purple is a home, green is usually savings, and blue is usually pension assets of some kind. So you can see we build up the picture in various ways to design the overall perspective, and then sitting inside that, as you're about to see, are all the different facets that go into designing that plan in quite a bit of detail to make it effective for you. So I guess if we sum up just a general broad plan is dream a little bit forward, deciding what's feasible. I mean, our aim is to help make it feasible for you, and often if it's optimized, then things you thought you couldn't afford, you can do. So you may be surprised. A lot of people are surprised. In a way, work backwards from a tax efficient retirement income. So what do you need in retirement? Then you have to work backwards really and go, all right, well, how do we make sure we're on plan to deliver that? Am I doing the right things without spoiling my current lifestyle to help me get there? The earlier you can do all that, the better. Make sure you have a tax effective savings plan. So if you are accumulating more, then there's ways to do that tax effectively and structure that so that you're ready and have money in the right pots as you get close to retirement rather. Consider a lifestyle cash flow plan. So that's the core of what we do in our initial consultation with you. And we suggest that you really do consider doing that, and it's a valuable way. We can look at loads of scenarios as well. And the other thing is just simplify. A lot of people have stuff all over the place. It's quite complicated, quite messy to manage. Often just simplifying a lot of it is part of the task, which means it's clearer and it's much easier to manage. A key aspect for an Australian in the UK or planning to retire in the UK is two main ideas. One is your tax residency, and the other is what's called your domicile status. So we bring this up because some people want to spend both time in Australia, they may have family still back there, but they mainly want to live in the UK and they want to split their time. but that might mean that they are possibly considered tax resident in 2 countries. So it starts to get a little bit more complicated, and you have to rely on accounting tax credits and tie breaks to try and decide which tax you're paying, or possibly even do both and have accountants use tax credits from the other system to offset the local tax. One key issue though is that if you are from Australia, then you'll be classed as a foreigner in Australia. So if you've still got income assets there, you lose a lot of advantages, which maybe you've already encountered, maybe you haven't. Depends how long you've been here and what stage you are in that process. That does bring that up, and this is how long have you been in the UK. Some may have been here only 7 or 8 years, perhaps. Others have been here 20 or 30. But it's a key aspect of a lot of the planning. And I say that because if you are an Australian and you come over and live in England for a while, you're classed as non-domicile, which means you're regarded as an Australian. That's your home in essence, in a kind of tax context. For a period of time while you come to Australia in that status, you only pay Australian tax on anything you earn in Australia, so long as you don't bring the money to the UK. But there is a point in time, which is 7 years out of the last 9, where you start to have to acknowledge tax in your HMRC returns. And that carries on, and so it's an important consideration. A lot of people ignore this or don't understand it, and then end up in a fair bind because they really do need to report it here as well. There's a concept called deemed domicile, which means if you've been in the UK for 15 of the last 20 years, you definitely have to report all your worldwide income to the HMRC. So there's that process of reporting your earnings and your investment earnings and those sorts of things. But it also then starts to affect your inheritance tax. So in Australia, obviously we don't have it, but in the UK, that is a concept. And once you're deemed domicile, then all your worldwide assets will be subject to inheritance tax over certain limits, and that's 40%. So this is a critical element to get right in terms of whether you are going to spend time in different countries and just how long you've already been here so far. And there's different steps in the process at which you need to act differently with respect to your tax and your inheritance tax. So I think it's really important that you determine your tax residency and be clear on that, particularly if you start mixing your time. It's not as simple as just time in a country. It also, at least in Britain, relates to how many ties you have: a home, a job, close family, etc. So you may only be able to spend 45 days here before you're classed as a tax resident, for example. In Australia, it's probably a little bit more intention-based. So that's one issue. Be clear on your domicile status, particularly in relation to your income tax. You often need to seek professional advice for a lot of this because it does get quite complicated. Really make sure you understand your obligations with tax in terms of tax returns in both countries. A lot of people neglect them in one or the other, and then there's quite a big cleanup job to sort a lot out. And then plan for changes in domicile and tax residency. So you know if you're staying and you're going to get to 15 years, then there's things you can do in advance of that, as you'll see later. And so on, but you need to start preparing for changes in those circumstances. I guess I said earlier that it really does help to work backwards in your retirement plan. And it helps because in the UK, unlike Australia, who really just have one income tax statement and you put all your gains in that one statement. So it's very simple in that concept. In the UK, there's different allowances you have. So you have an income allowance of 12,500, you have a capital gains allowance, a dividend allowance, a savings allowance. Then there's other instruments like ISAs where everything is tax-free when you take it out and as it's growing. And then a UK pension, you get 25% tax-free. An onshore bond, you get a 20% tax credit. So what I'm driving at, I suppose, is that part of what we work on is working out how we would set you up so that you can make the most of those allowances by having different types of investments to make sure that as you go through retirement, you're paying as little tax as possible. And with that idea in mind, it's working backwards, saying, well, how much do we build up each bucket, if you like, to take advantage of these? So it's really important that that decision's made. That can include sources possibly from Australia if you've got superannuation there, for example, or you might have investment properties. All those need to be taken into consideration. They will have different tax elements because they've also got to be taxed in Australia as well. So it's important to not all that and be very clear about where we're heading in that process, and then working backwards from it. And that's a huge value that can be added in retirement stage. Just a few other items, I guess. One aspect of British taxation is that capital gains are generally taxed at 10% and 20% depending on your tax bracket. But if it's property, it's 18 and 28%. So it can seem attractive to have properties here, buy-to-lets, etc. But once you come to sell them, then it can be a bit more onerous in terms of the capital gains. So again, the type of asset you have and how it's going to be taxed matters. ISAs, as I mentioned before, are zero tax. So they're a great instrument to accumulate in for retirement, because they can augment your other tax sources. On the taxable side, we know some of us will have superannuation. You can get tax relief on a lot of it if it was from employment when you were in Australia up to 2017. So you can get a lot of it out tax efficiently. The HMRC will tax it as income, and so therefore at that point it's really important to get the calculations on tax done right, and that then be incorporated into your income plan. You can, if you take them as cash lump sums, generally not pay a great deal of tax if it works in your favour. If you've transferred pensions over to superannuation from the UK, then that's a different issue. Property income's taxed, state pension is taxed, and of course there's other sources that are taxable. So again, you know, the plan really should be trying to understand where each of those sources are contributing, and that usually depends on how you then invest in each of them, whether that's aggressively or conservatively. This is an example. It was related, I think, to some of the cash flows earlier, but it just shows that, I guess, a little bit of the complexity. You don't need to understand the diagram too much, just more the change in colors over time. So rather than be a defined pattern, you can see that there's a mix of colors, and that's just using the different types of assets at different stages over life. You'll see the bottom dark blue bar is the state pension starting. So once that's started, you don't need as much money from other sources, so you can slow those down. The two big yellow poles are two downsizes of homes. So as the person gradually, family left home, it was downsized, and then as they got more elderly, maybe downsize again, in part because they were starting to run out of money. And it was another way of perhaps releasing some equity and putting it in. But you can see that's a combination of selling savings early in the piece, and then eventually pensions, and so on as the rest of the period unfolded. So you can see it's a weaving together of those types of facets to get your retirement plan. That's why it's so important to plan in the first place as you lead into retirement, in other words, the pre-retirement phase. So actions you can take, work backwards from in a tax efficient retirement income model, if that makes sense, so that we're kind of clear about where you're heading with things. Make use of ISAs definitely where you can. Take advantage of pension reliefs. If you're still working, particularly, you can save up to 40% tax. That grows while you've got it invested, and then you can capitalize not only on some of the 40% when you take it out, but the growth on that 40% if you're a higher rate taxpayer. For those that are basic rate taxpayers, if you can salary sacrifice at your company, you'll save an extra 12% on top of the 20%. So that's 32%. So that's still a generous saving that you can either put in as an investment or perhaps take as after tax pay and put in other investments. I guess the other thing is be clear on the role and the taxation of Australian assets. So if you've got them and you're keeping them, that's fine, but you really need to understand what role they play ultimately in your income generation activity. And that's something that we can help you decide. Property, we often get asked, well, in retirement or building up to that, should I sell it? Should I keep it? How should I think about it? This is a difficult one, and we're not property experts. We don't claim to be, but typically, I guess we think it's one asset. It's not diversified. It can be very, very lucrative, as we know. A lot depends on which place you've picked and how well that's going. But I guess the core aspect of it is you've got a buy-to-let, for example, is are you getting any capital growth versus what the rental income is after you've paid all the expenses and possibly a mortgage, etc. So it's a real trade-off. If the capital growth's good, or the income's good, or they're both good, then that can sway the decision, but it's quite a tricky calculation to get right. It's also, in retirement, difficult to decide sometimes whether a property is useful, because the capital growth is great, it's making you richer, but it's not something you can easily turn into income until you sell it. So it's not necessarily always the best asset. And certainly in the UK, because you can't claim much of the interest on your mortgage, it's not necessarily always the most tax efficient income option either. I guess the other trade-off is, should I basically use it as a mortgage saving vehicle? You know, I borrow a mortgage, someone else pays the rent. In essence, they're paying the mortgage, and some of that can pay the principal. So it's a savings plan in one form. So you're building up that savings, but what's the capital gains tax implication of having a buy-to-let eventually? If you want to turn that into income, you'll have to potentially sell it. So it's a difficult set of trade-offs, but those are the types of things that need to be considered and we can weigh up for you. That's in the context of your other assets. If all is fine and you don't need to worry about it too much, we don't need to finesse it. But if things are a bit tighter, then it needs due consideration. If you're got Australian property still, same logic, buy-to-lets, so that still applies. There's different types of taxation though. One thing that perhaps you need to appreciate that people don't understand anymore, it only changed recently, is if you had a home in Australia, you used to be able to claim a primary residence tax relief and not pay any tax on it, or only tax in proportion to the time that it was let. That's all changed now. So sadly, for those of you who have a home that you've left there, you can't claim any more capital gains tax relief. So it's 100% tax now. If you're non-domicile, then you really need to be careful about remitting your money and making sure that's either taxed properly in Australia, but when you're remitting that it's acknowledged. So again, it's what role does it play in your income generation strategy, and is it actually paying off once all the taxation is sorted? We've talked about the domicile situation. So again, you know, property is there, but you've got to reconcile all that, make sure, again, it's playing the role you need inside your income strategy in retirement. The last part is that you are taxed as a foreigner if you live in the UK, but you have Australian assets. So you lose, for example, your personal allowance. So right from the start, everything gets taxed at 30 or 32.5%. So you lose some of those advantages. So it may be better that that asset just doesn't exist, because that money, the equity, can be put to good use, possibly in the UK, to generate a better outcome for you. Primary residence is always a difficult one. Ideally, it's best you perhaps have one and keep one, because you don't have any rent to pay, or hopefully you've paid off the mortgage. I guess the question for a lot of people is the merit of downsizing. I guess once the family's left, sometimes it's a big place, it can release a lot of money, and that can be invested to fund your retirement. And I guess the question we often get asked is, should I repay my mortgage earlier now that I'm retiring, or let it run? And that really just depends on the interest rate. So we can, again, assist in that calculation. So I guess it's determining the merit of property in your retirement portfolio. Definitely seek professional tax advice on all of it, particularly if you've got an Australian property, because it does require a clear understanding of that. Make sure your tax returns are submitted. A lot of people neglect that. Determine whether to pay off your mortgage or not versus other investment outcomes. If you can generate 5 or 6% growth, but you're only paying, or really saving 2% on your mortgage, it's sometimes better to leave the money invested for as long as possible and then pay off the mortgage. And always refinance your mortgages for the best interest rates. There's a lot going on in this space, and it's pretty cheap. So it's always good to keep that flowing to make sure that you've got as little outlay as possible.
Thank you, Stephen. Inheritance tax. Most assets are subject to inheritance tax. UK pensions are exempt. They don't attract the 40% inheritance tax like your other UK assets do. If you pass away before the age of 75, your pension funds are paid tax-free to your beneficiaries. If you pass away after the age of 75, they are taxable at the beneficiary's marginal rate. So there's a line in the sand that HMRC have taken where the rules have changed for pre or post 75. As Stephen mentioned around being UK domiciled, if you've been living in the UK for 15 out of the last 20 years, you'll be liable for inheritance tax on your worldwide assets. There are some allowances, however, you can set off against inheritance tax. Everyone has a 325,000 nil rate band is what it's called. And there's also 175 residence nil rate band based on the value of your property. That gives an individual £500,000. So as a married couple, or just as a couple living together, that gives them a total inheritance tax allowance of £1 million, and inheritance tax will only be chargeable on assets over £1 million. Any gifts in the last 7 years may be liable for IHT if they're not within the annual exemption. And I'm not sure if you're aware of this, but HMRC requires that the payment of the liability before the completion of probate, which basically means you have to settle the inheritance tax bill before your assets are distributed. Okay. So on the moving on from the actions from that, so it's a good idea, very advisable to build your pension assets whilst in the UK. They grow tax-free, and as we've covered, they fall outside your estate for inheritance tax. Consider means of mitigating inheritance tax through trusts and outright gifts. Trusts are very tax advantageous. You will relinquish ownership of the asset, but you don't relinquish control of the asset. So it's a very, very good way of moving things outside of your estate, but still keeping control. You can also ring fence Australian assets, depending on your circumstances, before becoming domicile. We can look at trusts for that purpose, and that keeps your Australian asset away from the UK taxman. The other option that we could look at is life assurance to pay the inheritance tax prior to probate completion. You take out a life assurance policy for the value of your potential inheritance tax. On your death, the life assurance proceeds are paid out to the estate, which pays HMRC, and that means that your estate isn't devalued by 40% before it gets distributed to your beneficiaries. Pass any inheritance on to the next generation. If you're beneficiary of a will, you can apply for deed of variation within a 2-year period. What that means is that you can change beneficiaries, add beneficiaries to the will, and the idea here behind that is that will dilute any tax that's payable, and it's a good tax efficient method. The other advice is obviously to spend it. If you've worked hard and accumulated your wealth, you want to spend it and enjoy your retirement. And as we say to a lot of our clients, there's no point being the richest person in the graveyard. So there is that to consider as well. Looking at wills and power of attorney and taking care of your loved ones. Obviously, we're going to cover off the importance of making a will. If you haven't made a will, unfortunately, you will what's known as die intestate. And the rules are very different if you're married or if you're not. It just basically means that it's not your wife or your husband may not benefit from the whole of your estate. So it's really important that you make a will to stipulate what assets are to be left to which beneficiary. With the layers of complexity that leads to, we always recommend that you have a will in each country, i.e. in Australia and the UK. If you have any assets in Australia which will be left to your children living in the UK, you may not be charged inheritance tax on those assets, but you may well be charged capital gains instead. So we will look at that for you, and that's something which is worth considering. Again, spouses or relatives are not automatically given power of attorney in the UK. So you will need to set that up and decide who you want to act for you if at any time in the future you're unable to sort out your affairs. Pension nominations are very, very important. You'll need to ensure that the death benefits are, the form is completed with your existing pension company. That is particularly important if you want anybody else apart from your husband and wife to receive the benefits, i.e. children. If you have children, say, from a previous relationship, it's very, very important that you nominate who the beneficiaries are going to be on your death for your pension fund. It's not worth letting the pension trustees decide how that is distributed. Okay. In Australia, de facto relationships have similar rights as married couples. Unfortunately, that is totally different in the UK. If you're not married in the UK, you're not entitled to your other half's estate, so to speak. That will obviously create some inheritance implications. If you're not married, you're not entitled to certain state benefits as well, so that can lead to complications there. Spousal transfers in the UK can be tax advantageous. Currently, if you husband and wife swap assets between each other, there's no tax liability, and it's a very good way of equalising the level of assets each of you have from a tax efficiency point of view for inheritance tax. Divorce and separation, it's very important that you take the correct advice and sort out your finances soon after divorce or separation. You get everything in place and have a plan. Unfortunately, we have come across certain estates where that hasn't happened, and someone's passed away and they haven't sorted out their own finances, and it has left the estate quite messy. So we would recommend that, unfortunately, through divorce or separation, you do have a timely plan. So ensure you have wills in each country. Same for power of attorney. Make sure you nominate the people you want to act for you. Australian relatives, consider the implication of wills, especially if any of them are going to benefit or through capital gains tax. I can't stress highly enough the pension nominations are up to date and how important that is. And obviously be aware of the implications of your relationship status and how the UK treat married couples and cohabiting couples differently than Australia do. Your state pension entitlements. When you come over here to work, if you've worked a minimum of 10 years and paid the relevant national insurance contributions, you will be entitled to a state pension. If you work for 35 years, you will have received the full amount, which is currently £9,200 per annum. That rises with inflation. If you go back to Australia, you will still receive it. It just remains level and it's not index linked. If the husband or the wife are at home looking after the children, you can get credit on your national insurance contribution. So just because you're not working, it doesn't necessarily mean you're going to lose out on a proportion of your state benefit. So that is very important. So as soon as you start working in the UK, make sure you pay the correct level of national insurance. You can check your entitlements on the government website. It tells you how much you need to pay if you want to top up your contributions to maximise your state pension. So that's always a good suggestion. And obviously factor into the retirement income, because 9,200, you know, is a good sum and it's integral to your overall cash flow planning, as Steve alluded to in the earlier slides on our cash flow planning tool. Looking at the unexpected and considering what to do, making sure you and your loved ones are protected. Income protection will look at you covering your income in the event of long-term illness or disability. Critical illness will pay out a lump sum if you're diagnosed with, say, heart attack, stroke or cancer. Life assurance is particularly important if you have a mortgage or a debt, or if any one of your family is relying on you financially. Again, can't stress the importance of making a will. Care plan costs, they will change depending on whereabouts in the country geographically you are, and also the level of cover or the level of the care you may well need. It's fair to say that it is expensive. It's probably not something that was discussed 20, 25 years ago, but it's very prevalent now when looking into retirement. If you have more than £23,250 in savings, you will be expected to either self-fund or subsidise your own care. So 23,000 is not a lot of money to have. If you exceed that in savings, you will be expected to pay. So that is worth considering the outcome of that. So ensure protections are in place. Ensure you have adequate liquid funds as well for any emergency. Consider a care plan and the cost behind that, and don't forget wills, as you've already covered. One thing I would add to that is, which is very important, is putting your life assurance policy in trust. If you have a life assurance policy that's not in trust, that lump sum of money is paid out, but it's going to fall inside your estate. And the chances are your relatives are going to be hit with a 40% tax bill on that. So it's worth checking if you have any life assurance currently, that it is correctly written in trust, so the proceeds fall outside of the estate and your beneficiaries receive the full amount. I'll now pass you back to Stephen.
I guess we've talked about your assets and what role they play, what role they might play in retirement. So I guess one issue is making sure that eventually you can make the most of those by transferring some of those assets to the UK. They may be the proceeds from a property sale, for example. One of the big questions we get asked is about superannuation. We haven't really discussed it in detail, but you can get access to superannuation when you're fully retired and meet the Australian release conditions, which typically is earliest is 60 years old, subject to being retired almost completely, except for 10 hours, I think it is, a month of work. Or at 65, you can still be working and you can take it at that point. So those are the points at which you can get access, which is obviously beyond 55, which is the UK age for retirement at this stage. That's moving to 57 in 2028. But the superannuation may or may not be taxed. Well, it'll be the starting point from the HMRC is it will be taxed. So from that point of view, it requires tax consultancy to basically work out how much of it may in fact be subject to foreign service relief, and have that calculation done carefully in conjunction with how much of it can you take each year to sensibly stay under UK tax rates, so you're not moving up the marginal tax bands too quickly. I guess the pros and cons of when to sell these assets, when to move these assets, all needs an orderly plan. It's not necessarily just let's clean everything up all at once and that's a good idea. Sometimes it's better to phase it to make use of tax allowances and other advantages. It really is an area that needs professional advice, which can sometimes mean fees are paid, I guess, for the knowledge of what to do or not to do, but sometimes that can avoid some pretty hefty mistakes in those areas. I guess not always do we know how life's going to work out or that our plan is going to work out. You know, many people make a plan, they head off somewhere or they come to the UK, and there's reasons that might all need to change. So it is possible to reverse directions. I just guess the watch out is if you think that might happen, then you need to perhaps plan for it a little bit. Sometimes, you know, it might take up to 5 years out of the UK to re-establish elsewhere your status. So it can take a little bit of a while. Because super is now at an older age, if you do move, then you were about to retire at 55 and take access of the UK pensions here, you now may need to wait a bit longer. You can transfer your UK pensions to Australian superannuation, but you won't be able to access them until 60 or 65. I guess one big irreversible decision is if you do get your super out of Australia in your early 60s, for example, and you repatriate that to UK and invest it. A, it's now in your estate over here, and B, you won't be able to put it back in the superannuation, nor can you put it in a UK pension. So it needs to be a move that you are fairly comfortable with, and you understand the implications of withdrawing it. So you would lose a significant advantage in that it's not taxed when you take it out in Australia. So it's a really important decision to be clear on. So from that point of view, it is possible to reverse, but I guess we always encourage people to think about the possibilities that may be and make sure that we work with you to understand just what might happen or what your views might be, therefore not bind you into anything that's going to create a huge disadvantage down the track if we can manage it differently. So in that context, I guess, again, it's be clear on the tax implications of assets and these transfers. Always consider an orderly disposal. And that relates just to when you might need it in your retirement plan as much as just when it's tax efficient to do it. And that may actually be in retirement because your income is much less. You're not sure where you're ultimately settled, then try to avoid very, very expensive, irreversible decisions that we need to weigh up with you. I guess, as we've said earlier, be clear on your tax residency and domicile status. That's always an ongoing thing to be clear of. The longer you're here, that matters. Once we get past the 15, I guess it settles down. The last point we haven't gone on too much is that if you are moving money between countries, we recommend using a currency transfer specialist. The rates are much better than a bank-to-bank transfer. And in some cases, you can also lock in a forward exchange rate, etc. So you've got some certainty over when you transfer that money. And they may also advise you on transferring it in waves, if you like, to make sure that you're not prone to a big currency swing. And so on. So we suggest that you really look into that. We can refer to a lot of these professionals, tax professionals. We have a sister company, associate company, bdhTax. We've got mortgage specialists, currency specialists. The one thing we can help is just give you some direction and other professionals that we trust and use to support you. If we try to bring it all together now, I suppose this was just a mini case study of Lisa and David. They're both 54-year-old, they're empty nesters now. I guess it's just a way of bringing together a lot of the knowledge that we've talked about, and I guess show that each individual item is its own topic, but when you look at someone's entire life and their situation, it all comes together, and that's, I guess, one thing that particularly we can do and help. So this couple are 1 year away from deemed domicile. There's not a whole lot they can do about that other than go back to Australia. They're building up UK pensions. I guess the question is, what portfolio, how aggressively should they be invested? Most likely, if they stay in the UK, they would draw in their super first. So the UK pensions will go much later. So they should be invested for strong growth. Got superannuation. That couple's question is, okay, so how most of that was derived from, well, all of it was derived from work prior to 2017. So how much foreign service relief are they going to get? The clock is ticking on that because the relief is not available after 2017. So the longer that goes, and it's got at least another 6 years to go, then it's increasingly becoming more taxed. So if you are in that zone of being able to get it because you're closer to 60 or fully retired or 65, then it is worth considering what the implications are and doing it sooner rather than later. That also means that fund that it's invested in may be slightly more conservative, because if you are going to move it, you want most of it to be there when you want to move it. Not be in a downswing like we've had with COVID when you're around there. They got a home with 12 years left on their mortgage. It's an offset mortgage, so their pay goes into their bank account and then can go against their interest. It's interest only, because again, this couple thought they were only coming to the UK for 5 years, but turned out they really liked it and wanted to stay. But they actually pulled a lot of the money out that was their equity and invested in ISAs. It's all tax-free, but it's growing at 6 or 7%. Versus just paying off the interest at 2.1%. If the interest got up to 3 or 4%, that whole story would change. But that two issues. One is they're investing to make more money for their retirement, but two, they need to pay off that interest-only mortgage in 12 years' time. So they need the funds carefully calculated to be able to do that. And the ISAs support that because it's tax-free. 60% of their wealth's in their home, so a big decision is, it's only appreciated at less than 2% for a decade, which is not impressive capital growth. So do they really decide to downsize or leave it as a lifestyle choice and go, all right, I'm not as rich as I could be. And maybe if I don't need it, I'm lucky. But do I downsize and do I invest the excess cash for greater income in retirement? They're both still employed. So it's a question of how much do they put in the pension versus how much after-tax money they might put in other savings plans like ISAs. And then, of course, the opportunity to salary sacrifice their pensions is there for both of them to get a lot more tax relief. They have shares in an Australian company they inherited from their mother that passed away. That's now subject to IHT, but because there's 1 year to go before their domicile, there's a possibility of putting it, like Kevin said, in excluded property trust, which keeps it out of bounds of the IHT. So that's one thing that needs to be looked into, and the clock is ticking. So a little over 1 year to go on that. They stand to inherit a lot more of the Australian company if the father passes away. Again, in that situation, a bit different. It would be subject or not subject to inheritance tax because it's a business being passed on to the other generation. So you can have business relief. So it does depend on the type of asset that you are inheriting in terms of whether it causes a problem down the track for inheritance tax. And then state pension, they both came in 2007. One started work, the other was a stay-at-home mother. So their record's 13 and 7 out of 35 years. Again, how long do they work? How much do they need to top up and make sure they get the maximum state pension, which is in practice somewhat free money down the track. And then the last part is they've not done wills or put in place power of attorney. So they really need to sort that out. So you can see when we bring all these issues together, and you can see with the cash flow planning, it helps paint a picture of how all these elements are dealt with in an effective and clear fashion to make the most of your overall finances, which really is, as you'll see soon, I guess, as much about what kind of lifestyle you would really like. And that's, I guess, the ultimate outcome. A lot of people perhaps think retirement is going to be just a rosy event, but not always is it like that. And not always are people prepared for it. You know, some may have had major jobs and roles, huge status in life, and suddenly they don't have that anymore. Well, they've got a lot more time on their hands and they're not quite sure what to do with it. Flip side is people got a very clear plan and know exactly how to enjoy it. So really things can change a lot. It's a big disruption emotionally. So you need to also make sure that that's catered for. And when we respect that, that's part of the decision. And sometimes things can change through that period. We always say the money is there, but it really just provides the freedom. So if you've got a really good financial plan, it gives you the freedom to enjoy the lifestyle that you want without excess anxiety over your finances. Really, in the end of the day, it's about your life and your lifestyle. It's not about necessarily how rich you are. So sometimes the best solution is not making the most of your money. Some couples, we can say you will be better off retiring in Australia and you'll be much, much wealthier. But it sounds like your lifestyle is much better here. You prefer it. So why don't you just accept that you'll have enough for a comfortable life in either country. So you don't need to make the choice that's just the economically rational one. And really, I guess what we're driving at is that because this work is done with you, the ultimate outcome emotionally is that you are hopefully got a lot of peace of mind and also a lot of clarity over A, you're going to be comfortable, B, what you need to do to make sure you are at each stage of your life. It isn't all about retirement, because the more you just sacrifice now to put into retirement, the less you get out of the your current lifestyle. So it's working a balance out so that each of your life stages are backed by a clear financial plan. So summing up, does take careful planning and a lot. Assets in the UK and Australia, as you're probably well aware, if you still have the mix, is extra complexity really. Because we're licensed in both countries, we can cope with that and we can manage that and help give you advice. And then there's other advisors like tax, bdh tax, etc., that can give very, very technical tax advice as needed. Failure to plan, as we know, that can be very costly. There's a lot of obvious little things that people leave on the table just because they're either too busy or they don't really know. And so even in a very basic plan, there's usually lots of opportunity. And you know, as experts in this field and in both countries, we believe we're ideally placed to help people that are in this situation. That's it, folks. So I'm going to hand over to Simon in a moment, who's hopefully been tracking your questions. If you want to add some more, you're welcome to. I will change the slide just to say, if you would like a chat with an advisor, I'll leave this page up while Simon goes through the questions, then we'd like you just to send an email to this email address. What would help is contact details, but certainly if you could just give us a guide to your age and I guess some idea of when you're feeling like you might be planning to retire in the UK, that would just give us some little background to just help us understand. So I'm going to hand over to Simon Harvey now and just he'll read out the questions and he'll also answer them. Feel free to add more as you go along if that prompts any other thoughts. Simon?
Thanks, Steve. We've got a few questions to work through, but if you do have any questions, please send them through in the Q&A function, and we'll look to address them all today. The first question we've got is in relation to Australian superannuation and how that might be treated for IHT purposes. It's been asked whether Australian superannuation can be placed into trust to ring fence it from UK IHT, which is a good question. As the guys mentioned earlier, pension funds can be good estate plan vehicles they fall outside of the scope of UK IHT, and that also applies to certain overseas pension schemes. So what you need to consider is whether your Australian superannuation fund will be considered what is known by the revenue as a qualifying non-UK pension scheme, or QNUP for short. If the Aussie Super Fund does qualify as a QNUP, it will sit outside of your estate for IHT, and then it might come to a decision as to whether you draw on that from an income tax perspective first versus a UK pension, for example, and those are the kind of conundrums that we can help with.
I mean, a related question that comes to mind is, can I transfer, if I'm not in the QNUPs now, can I transfer my superannuation into one, or do I risk causing complications?
Yes, you can. Yeah. So there are certain conditions that an overseas scheme must meet to be classed as a QNUP, including restricting access to age 55 or greater. So there are certain things that you can do to an Australian scheme to ensure that it qualifies as QNUPs and thus falls outside of the estate for IHT. We've been asked to expand on IHT strategies and passing wealth on to other generations to reduce or eliminate IHT bills. This really is, I think, in relation to gifting money into trust. If you gift money into trust as a UK resident, any gifts will generally be potentially exempt transfers, or PETs for short. And that means that it will form part of the IHT calculation for up to 7 years. But if you survive 7 full years, then it's outside of your estate for IHT, hence there's a potentially exempt transfer. Now, if you are still, or if you're not yet deemed domicile in the UK because you haven't spent 15 of the past 20 years in the UK, you do have an opportunity to pass assets into trust, and they immediately fall outside of your estate for IHT, i.e. you don't have that 7-year period. So if you're in year 14 in the UK, for example, you're just about to tip over into becoming deemed domicile, there is an opportunity to put money into trust and for it to fall immediately outside of your estate for IHT. The nature of that trust can mean that you are still a beneficiary of the trust and you still have control of the trust. So it doesn't mean you're giving away all rights to the money. It is a very effective tool in the right circumstance. The other thing you can do is make use of annual gift allowances. They're fairly nominal amounts, but you can make gifts within, if they're within prescribed amounts, they're outside of your estate immediately as well. And that's something you can do on an ongoing basis. We've had a couple of questions in relation to state pension. As Steve mentioned, or if you are not living in the UK in retirement, if you're living in Australia in retirement, the UK state pension is not index linked. We've been asked, if you come back to the UK, do you get the indexation or is it reactivated? The answer is yes, it is reactivated for the period that you are in the UK. So if you split your time between the UK and Australia and you come back for six months every year, say, you can contact the DWP and ask for them to index the pension during the period that you're in the UK. For the periods that you're outside of the UK, you won't get that indexation. Another question in relation to the state pension is around the credits that you will get if you are looking after children. Up until the age of 14, if you are caring for a child, you get something called home responsibilities protection, and that means you're classed as having paid national insurance for that year. So if you have a child and you're looking after that child for the first 14 years of their life, you would get 14 years of state pension contributions, regardless of whether you've worked or not. The best thing to do is to check where you're at with your state pension entitlement by requesting a state pension forecast online. It's very easy to do, and you get that back quite quickly, and it will help you identify where you are, what stage you're at with the state pension, whether there are any gaps in your record, and whether you need to consider making any additional voluntary contributions to get the state pension. As a general comment, making voluntary contributions actually represents very good value, and so I'd encourage you to make sure that your state pension, you're on schedule to have a full state pension entitlement. Another question in relation to superannuation, whether the annual income would be taxed in the UK if you're still considered domicile in Australia. Yes, generally, even if you're non-domiciled in the UK, you're generally going to pay tax on your worldwide income unless it is a very nominal amount, less than £2,000, or you pay a very substantial levy to elect for a remittance basis. And if you elect for the remittance basis, it means you don't declare your overseas income, but the cost of that levy is significant. So generally, your worldwide income is going to be accessible to UK tax, including state pension. Now, the way you decide to draw your state pension is absolutely key. Any income is going to be accessible to tax, but there are certain strategies that you can employ to make use of foreign service relief, where you can extract that pension in a very tax efficient manner. And that's something where we can add significant value by getting that strategy right. We've been asked about assisting individuals with assets in numerous countries. If you have assets in Australia, UK and Europe, for example, yes, we can help in that situation. We have a network of advisors that we work alongside, tax specialists, who can give us the tax advice or work with us to develop a plan which considers any tax issues in a third jurisdiction. Our core focus is UK and Australia, but we do deal with globally mobile individuals, and so we do have a high level understanding of most main destinations for UK expats. I think that's largely it with the questions that we've had so far. If anyone has any further questions, please send them through. Otherwise, I think we will wrap up the presentation shortly.
Well, I think we'll do that just to respect your time. We appreciate your interest, and hopefully you've got some value and learned something from the session. As we put up there, feel free to ask us for any help, or there's no cost to an initial chat, nor no obligation. That might just help give you some direction. And understand whether we would be someone who can add value and help you out in this phase of your life. So thank you for your time. We'll send through, as I said, the presentation, and we'll send through the link to the video so that you can remind yourself, possibly share it with others who you may know might be interested, but weren't able to come at this time. And we hopefully get to speak to some of you in the future. So thank you very much, folks. Bye-bye.